Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical performances. The S&P has rallied for 6 days off of news of an interim peace deal with Iran, leaving many investors looking forward to a continued rally to take advantage of. Is this truly the end of our pullback, or is this just another bull trap like in June? Our new Fed Chair, Kevin Warsh, had his first meeting on June 15th of last month, and many were speculating if he would remain nonpartisan like the precedent every Fed Chair had set prior. When Kevin notified the public that half of the Fed officials had penciled in at least one hike by the end of the year, it was made clear that Kevin and the Fed would do what they believed to be best for the economy, rather than the opinion and influence of our current administration. In due time, we will know if the decisions of the Fed will correspond to what the data is showing, and given a hotter than expected jobs print in June, the narrative for a hike just became that much more valid. The Fed made that clear in the last meeting with the recent hawkish shift, and the S&P came spiraling down 3% over the following 8 days. Now, this pullback was short-lived as news came out of an interim peace agreement being made between the U.S. and Iran, reopening the Strait of Hormuz for oil shipping on the 18th of June. We continue to see that rally push further as we lead into the close today. The major focus for the next few weeks is the strength of our labor market and inflation, as these two factors will continue to influence expectations of the Fed. If you are a bull, we want to see inflation declining significantly, along with our labor market to show signs of slowing to allow room for consideration of a Fed cut. As for key economic prints to look out for over the next 2 weeks, we will have our CPI print next Tuesday, along with our next jobless claims and unemployment prints. Should we see CPI remain hot despite oil prices coming down, or the labor market continue to show unexpected strength, this will shut down any inkling of rate cut expectations, and we are likely to see further downturn in the markets. Given many economists have expressed that our recent spike in CPI is majorly due to oil, they expect to see CPI start to decelerate given oil prices have rapidly come back down, making a hot CPI print unlikely. This certainly would create factors more in favor of a continued bull run. Now let's talk a little bit about S&P's price action. We saw a bullish break outside of a triangle last Thursday. This implies a retest of our two pivot highs at 75.80 and 76.20. We are currently testing the 78.6% retracement from our drop back in June. Should we see a rejection here in this zone, meaning prices come back down below the 61.8 after it fails to go higher than 78.6, it is very possible we see the S&P back in the 7300s, similar to the last rejection that occurred on June 15th. So be very careful entering new longs this week, as should we see any negative catalysts, this would be a likely area to pivot back down. If we continue to see prices break through the 78.6 and our pivot high at 75.78, chances are we see all-time highs again. With the Iran conflict seeming to ease for the time being, oil coming down, and a brewing narrative of a shift back to dovish, it's very possible that's how we see the S&P play out over the next 2 weeks. If you notice, S&P is potentially playing out an ABCD pattern in which a break past 75.78 on the C to D move would imply an upward target of 1.27 to 1.617 of the BC move seen in the red at 76.60 and 77.59. So all in all, you really want to be paying attention to this yellow zone. How we react within this zone in the next couple days can definitely really be a determinant as to which direction we are to go. If you're bullish, you really want to start seeing closes above 75.43 or the 78.6 retracement level, and ultimately go on to break our B point at 75.78. Now, the first stock I want to talk about is GM, or General Motors. And what you're seeing here is GM's closing price over the past 10 years and in the first panel, and RSI in the second panel. Now, RSI is a momentum indicator, and typically whenever you see RSI cross above 30, that's a buy signal, and when you see it cross below 70, that's a sell signal. In particular, whenever GM crosses 27, you'll notice that these green dots show up on the price action, indicating that RSI signaled a buy. Now, we've had 10 triggers in the past 3 years that have realized this is the 11th trigger that is set off last Thursday. Now, 90% of the time, or 9 out of the 10 times, the price was higher when looking 116 trading days out, or roughly about 6 months. And the price was on average 33% higher when looking on the 116th day. Here you're reviewing GM's reactions to those RSI triggers, where you saw those green dots on the line. Now, in the x-axis, this is days out from that trigger, and on the y-axis, this is cumulative return. So in other words, what you're seeing is what your returns would be over time if you had bought GM on each one of those RSI signals. The blue line is your average return, or in other words, composite return across all the triggers, right? So you can see we lead up to that 33% on the 116th day. In yellow, we can see this was the trigger from March 16th, and it's still currently playing out the 120-day reaction window. Now, this isn't being incorporated in any of the stats as of yet. Once it reaches 120, it will also be included in the average. And as you can see, we had trigger 7-2. So there is a second yellow line. It's just hard to see because it's on day 1, but as you know, GM continues to trade, a second yellow line would essentially be displayed on the chart. So taking a closer look at General Motors price action, it's currently trading within a major support zone and resistance zone, around $88 to $85 a share in the resistance zone, and 70 to 73 on the support zone. It's also trading within a bit of a triangle in which its highs are closing in and its lows are closing in as well. Whichever way you tend to break out of the triangle tends to be the direction it continues to go, right? So if we start seeing price trade below this support line, maybe we start seeing a retest of our support down towards 70 to 73. And should we continue to trade upwards, we likely see a retest of the upper bound of our triangle. Should we continue to trade through it, as well as break through our resistance zone, then that opens up the door to see some of the higher prices potentially around the average performance we've seen based off the historical triggers. The next stock I want to talk about is HCA, and the strategy we're viewing here is RSI using connotation with another indicator called MACD, in which, similar to RSI, whenever the white line called MACD crosses above the red line called signal, this is a bullish indication, and generally the price will tend to go up. And so whenever you're seeing both RSI and MACD signal off, a green dot is represented on HCA's price in the top panel. We've had 4 instances in the past 7 years in which both of these have signaled off, in which the price rose on average 32% over the next 118 trading days, or 6 months. And in all 4 instances, the price was higher. So we have yet to see a signal in which the price declined when looking 118 days out from now. Just taking a closer look at the same chart, more honed in on the most recent trigger that we saw just today. In yellow is the composite return, or the average return across the 4 historical triggers. So if the price were to perform in line with the average of the historical triggers, this would be something that it would look like in terms of looking over the next 6 months. So this is HCA's reactions to the RSI and MACD signals, in which you can see the past 4 reactions over the next 120 trading days. In blue, we have that composite or average return, similar to what you were seeing on the previous chart, as well as the max and mid reactions as well. As you can see, The blue line, or average return, leads up to that 30% on the 118th day. Taking a closer look at HCA's price action, as you can see, it's currently bouncing off a major support zone that's been developing since around June of 2022. And it's currently attempting to break a major resistance zone that is generally near its previous all-time high. If we are able to break through this resistance zone, the next resistance we're likely to target is the neckline of this head and shoulders pattern that played out. Again, should we break through this, right, then ultimately our next target is our resistance zone at the top near our all-time high. This is what the 32% average performance would look like, reading out 6 months from our triggered price, bringing it to around $551 a share. On the downside, I put a stop loss of about 10% to represent a 3-to-1 ratio, and that's just in line with our support zone. Now, so should we break through this major support zone, that's fairly bearish, as the longer a support has been developing, and with the more contact points, the stronger it becomes. Hence, a break means a serious shift in trend. So ultimately, if you're a bull and were to want to play HCA, for example, you want to see continued trading through this resistance zone and ultimately sustaining it as support to go on to test that neckline just around 461. Third stock for today is Apple. Using the same exact strategy, RSI with MACD, we can see we've had 13 triggers in the past 7 years, in which roughly 85% of the time, the price was higher when looking 117 trading days out. Over that 117-day course, the price rose on average 24.73%. And as you can see here, whenever MACD and RSI have bullish signals, the green dots generate. Taking a closer look, we can see that composite return of the 13 historical triggers in yellow. So this is sort of what it would look like over the next 6 months roughly if Apple performed in line with that average. Now, this is all of Apple's reactions to that RSI and MACD strategy, in which, again, on the x-axis, you're seeing trading days out from the signal, and the y-axis is cumulative return. So essentially, if you were to buy Apple on every single one of these trigger dates, this is what your returns would look like over those next 6 months. So as you can see in blue, the average leads up to roughly that 21 to 22%. And in yellow, we have our current trigger that occurred on April 17th, roughly up about 16-17%, and very close in line with average at the moment. And as you can see, we have our trigger from today, which has not started generating yet, but a second yellow line will continue to generate throughout the chart. Taking a closer look at Apple's price action here, it's currently playing out an A, B, C, D pattern, in which if price continues to break through our current all-time high around 320, 317, right, it implies we go on to see 1.236 to 1.618 of our B to C move, right? So that would put our upwards targets of 327.82 and 344 should we start breaking through 317 and a half. As you can see, we recently had a bullish trendline break, which implies you go on to test your pivot highs that were developed along the way, right? So we reached our first target and broke through it. Our second target is that all-time high at 317.53 roughly. So again, right, if you start trading through it, right, our next two targets could be that 1.236 and 1.618. And should you start trading through that, right, maybe you start seeing some of the higher prices similar to what we've seen historically. And if it were to perform in line with the average, right, leading into December, it would be around $380 to $390 a share. Now, should we reject 317.53 and start trading back down, we could go on to expect, some retest maybe at 302, and maybe even lower at 288 before you see any further upside potential. Maybe you see sort of an accumulation pattern here. It comes back down and builds, and then goes on to break through your all-time high. But ultimately, at this point, what you're really going to want to pay attention to is that all-time high. If we start breaking through it, right, that's a great signal that we could go on to see some higher prices at these upwards targets. And if not, maybe hold off on any longs until we start seeing some structure rebuild and another break. The last stock I want to talk about is Walmart, and the strategy we have here is called mean reversion. Specifically here, you're looking at the premium or discount to a 100-day moving average, right? So if you see this value in the second panel at 10% or negative 10%, that means it's 10% lower than its 100-day moving average. Oftentimes this measurement can help you identify extremes in which when it reaches it, it's very likely the price will rebound back to the average, right? And so in this particular case, this is roughly about 12%. As you can see, when looking over the past 7 years, there's only been one other time really that it's been lower than 12%, in which we had 3 crosses signaled back in 2022. So since 2022, we've gotten our first signal nearly 4 years later. And so essentially what this is telling you is this is the cheapest Walmart has been relative to its 100-day moving average since 2022. Now, whenever we've gotten this signal, the price has risen 20% on average over the next 107 trading days, or roughly 5 months, in which in all 3 of those signals, the price was higher. In reality, it's truly one event because it was 3 signals in a consolidation after a drop in 2022. But the closest we've ever been back to this reading since that 7-year period was back in early 2025. When it nearly reached it, reached just about 11%. So as you can see, we're fairly discounted and at a spot that it's very likely for Walmart to jump and rebound. Now, taking a closer look at Walmart's most recent trigger to that mean reversion level, as you can see, this is what the average return would look like across those 3 historical triggers. Now, with mean reversion, generally your target is going to be reversion back to the 200-day MA, so roughly about $125 a share. Anything extra of that is essentially a cherry on top. But generally with mean reversion, your target is back to the average, in which generally you want to take some, if not all, of your profits from there, as it can be a fairly common spot for the price to pivot back down, in which you lose out on profits. So as you can see, based off this average performance, a realistic time frame in which that would be achievable is leading into October, mid-October, closer to November, for example. This is what Walmart's reactions look like to those mean reversion levels, in which in blue, again, you can see the average return across the 3 historical triggers. In yellow is going to be the most recent trigger playing out, in which it's currently only on day 1. However, as the days go on, the yellow line will begin to populate further out. Now, in the first month, we've seen prices or drawdowns as low as 5% before it's gone on to go higher, right? So what this tells us is potentially we see a pullback here further, in which you may get even more favorable prices and even more cheap relative to the 200-day MA compared to the current trigger price, right? So over the next month, keep an eye out for drawdowns potentially to 5%, right? And moving past that month, our average performance begins to really pick up, in which all of our reactions tended to continued to push further if they were already going up, and if not, went on to pivot to go upwards. Taking a closer look at Walmart's price action, it's currently trading in a neutral state between two major support and resistance zones, one being around 108 to 110 and one being around 134 to 136. Now, I went ahead and plotted what that 20.5% average return would look like, roughly about 5 months out, leading to October 16th, which brings up to our upward target around that upper resistance zone, around between 134 and 136. Now, in addition, it's currently playing out a ABCD pattern to the downside, right? So here's our A to B, in which it bounced from B to C. It reached, close to the 50% retracement of our A to B move. It didn't quite reach that prime zone between 61.8 and 71.6, but ultimately, right, so we measured our B to C move, and our C to D would call for 1.236 to 1.618 of our B to C move. So as you can see, it smashed that target to the downside, especially since we broke that pivot low, right, confirming that the pattern is playing out, right, and we're going to see us likely hit that target in the zone. So in terms of that 5% drawdown, you could potentially see, I was saying, in the first month, right? If I go ahead and draw down about 5%, right, that's really close to our stop loss that I've set here relative to 20% average gain to make a 3-to-1 ratio. And so if we were to see the ABCD pattern fully play out, right, we could see price come back down to 106.05 before we see any further upside, right? So I just mentioned that, just in case, to be wary that, based off historical reactions, we have seen price come a bit lower after the trigger before it actually gets better. Now, should we begin to build some structure down here, right, and begin to break back above our pivot low here around 111 or 112, that opens up the doors to come back up to our C point, as well as some of these other retracements originally from the drop. Ultimately, if we were to perform in line with the average, over that time frame, if we were to break back through some of these resistance points, it likely brings you to that resistance zone. Last thing I want to emphasize is, say you were to put this chart up for yourself and set it up, you definitely also want to set up that 100-day moving average, as again, what I noted before, really when you're playing mean reversion, that is your sole and prime target. Anything past that is, the cherry on top, but ultimately when you do reach this 100-day moving average, whether it's a bit lower as time goes on and it finally reaches it, you definitely want to keep an eye out and consider taking some off the plate ultimately. In the event it does treat it as resistance and begin to come back down to test back some of these lows that it's created. That's everything for today. If you enjoyed the video, please give it a like and subscribe should you want to see more, and I hope to see you in the next video.